Hello, can you hear me? Hello?
Hello, hello. You must be Oscar.
I am, yes. How are
I
you?
saw you were on early, so I thought I would jump on and say hello.
Yeah, no problem.
Yeah.
Thank you for having me.
So, yeah, so I thought I would find out what's been going on with you. You've got a great job someplace, right?
Yeah. Can you give me a second? I'm going to grab my water.
Oh, absolutely.
Thank you. Hi.
Yes, nice to meet you virtually.
Nice to meet you too, virtually.
Yeah, you wanted to make sure you got online. Are you still working?
No, I'm home now. I sent the Zoom link to my brother as well. We're going to be interested in purchasing a home together. So I figured it'd be good
Excellent.
for him too.
Excellent. Oh, that's so exciting. And yeah, I'm super excited about creative real estate finance because I think it is perfect for this market and a really great way to be able to afford a home in what
Right.
for many first-time buyers is a very challenging environment.
I had a question. So, like, I've been looking on Redfin and I see a lot of homes for a certain price and it has like a monthly price, like a monthly payment, price that like your
Right.
mortgage would be or your rent or whatever. Is that something that a first-time buyer can mitigate a little bit, or is that locked in stone?
I think that is based on the current mortgage interest rates. But as a first-time home buyer, there are so many first-time home buyer programs that provide either down payment assistance or even grant funds if you take a first-time home buyer down payment assistance class. I don't know if you've done that yet.
Yeah, no, I haven't.
Yeah, have I hooked you up with any mortgage lenders yet, Oscar?
I think you did. I can't remember her name, but I talked to her for
Cheryl?
maybe.
Might have been Cheryl Taylor, I'm guessing, if
Yeah,
it
yeah,
was a her.
yeah.
Yes.
So is that something I would need to discuss with her?
Yeah, I think that would be a good idea. If you're probably going to get super excited about what I'm going to share with you tonight, and we can certainly go that route. But I think it's really good to go the conventional route as well and know what your options are in the conventional financing, because often with creative financing, there's a cash out or balloon payment date, and you want to make sure you're ready to qualify for that. It'll be, um, well, I have an example of, seller financing that I did, and then I did cash out into permanent financing, but I was not able to get a conventional mortgage. So I ended up getting a portfolio loan, which is at a higher interest rate, not
Okay.
that much higher. Actually, right now it's looking like a great interest rate, but at the time it was a bit higher, and it was just because of the homes that I already owned and because I had a lot of income sources that the conventional lenders would not count as income. So, for example, I have rentals and people pay me through Venmo. Can you believe that if you get paid through Venmo, conventional lenders will not consider that income? Even if you could track it, they won't count it. So, there's a lot of different reasons why people cannot qualify for a conventional mortgage. that won't be your case. You will be able to qualify. You'll be a first-time home buyer. There's a lot of financing programs that are available to you that would not be available to someone who already owns property. So, yeah, I would recommend having that discussion, going through the process, just being ready for it. Even if you decide, let's say after this presentation, you're like super excited and you say, Wendy, I'm looking for seller financing. Help me find something for seller financing. We can do that. But I just want you to be ready when you have to cash it out, that you're qualified, you know what you need to do to qualify for conventional financing.
Okay.
Yeah. So, yeah, and your brother, is he working as well?
Yeah. Well, actually, he just got laid off, but he's got a lot of savings, and he's looking for another position. He's in HR, and he was at his last company for 10 years. So,
Oh, wow. Is this an older brother or younger brother?
younger brother.
Okay, but he's got more than 2 years in his industry,
Oh
although
yeah.
they definitely like him to be employed if he's
Yeah.
getting a loan.
Yeah.
And then where are you now, Oscar?
I'm at a company called NanoString.
Oh, I've heard of them. There's a big sign on a building.
Yeah. Yeah, there's one downtown.
Yeah.
There's and then I work at the place in Bothell.
Okay. And what do you do for them?
I'm a quality inspector too. I just inspect, pieces that are going to be used to make high imaging spatial biology microscopes.
Oh, how cool is that?
Yeah,
That is totally cool.
yeah,
And are you enjoying it?
yeah. It's really great. I like it a lot.
Yeah. How long have you been there now?
I've only been there a couple of months. I was in the same industry at another company, and I was there for about 2 years. Um, yeah, I was a quality inspector there also, and it was medical devices. And I make about 70,000 a year, so
Oh, that's
doing
awesome.
okay. Doing okay.
Yeah. Yeah, that's awesome. So hopefully the brother at least has some funds to contribute.
Yes.
Um, so you may find that the two of you will qualify differently for conventional mortgage, but between the two of you, if he could jump on this call, having some cash and some savings for a down payment on a creative finance deal is a big plus, regardless of whether he's currently employed.
Right.
Yeah. Yeah. Well,
Okay.
that's awesome. Yeah, I'm hoping we'll have a few more people show up. I had a number of people that asked me to send, I hope I sent the right Zoom link to everybody. I think I had the wrong Zoom link to start. Um, and I have a few people who said they probably couldn't make it or they'd be coming on late and they want recordings of this once it's done. So
Right.
we'll see how that goes. Yeah, so do you need Cheryl Taylor's information or you think you still have it?
I think I still have it.
Okay, all right. Yeah, just let me know.
Okay.
Yeah, we'll give it a couple more minutes before we get going here. At least a couple minutes. Want to make sure nobody's trying to get onto Zoom. Yeah, you may get your own private class here. You never know, Oscar.
Yeah. My brother said he was just getting out of the shower, so he should be on in a sec.
Yeah, yeah. I know it's tough. 5 o'clock is tough, but as people transition out of work and, right before dinner, so we'll see.
Okay.
What do you know about seller financing? Do you know much of anything or
No,
no?
not at
Okay.
all.
Oh boy, this will be eye-opening. It'll be eye-opening.
Yeah.
Well, brother's coming. He's going to be a few minutes late, right?
Yeah, let me see. Oop, I got some messages too. Yeah. I had one gal that came on last night. She thought it was last night. Oh, there she is. Okay.
Sharon Wu. Okay, I was just sending her the link. Hello, Sharon.
Hi.
Nice to meet you too, Sharon.
Yes, nice to meet you. I saw that you are the broker manager for EXP.
I am a broker. I have that higher designation. All agents are called brokers.
Okay,
But
okay.
yeah, and they don't know what to call you. When you've got that higher designation, I'm either an associate broker or a managing broker. But I
Uh,
don't manage anything for EXP. It just means I have that higher level um, certification.
I see.
And Sharon, where are you? Are you here in Seattle?
No, I'm in Southern California.
Oh, so nice to have you join us. Thank you.
Yes.
Yeah. I was promoting it a little more broadly, so I'm glad you could join us. Martine, so good to see you. Yes. And feel free, guys, as we get going. This is definitely interactive. You can unmute to ask any questions. I'm not good at looking at the chat while I'm doing this. So you can put questions in the chat, and maybe, someone can read them back to me or something when we get going, or we'll go over them at the end. But definitely feel free to jump in. Daniel, thank you for joining us. I know you are Oscar's brother, and yeah, you can turn on your video if and when you feel like it. You don't have to, but we're happy to have you here. So I think we may have a few more people joining us as we get going, but I want to be respectful for people that do show up on time. I know that this presentation takes about an hour, depending on the questions that you may have. So I think I'm going to go ahead and get started if everybody's ready for that. Sound good? All right, I'm going to share my screen. And hopefully this will work.
By the way, Wendy, if you need help with co-host, like admit people in, I will be glad to help.
Oh gosh, your skills are probably much better than mine. I'm lucky I got a slideshow done. So Sharon, if I need help, I will ask you to help here. So can you guys see the full screen or do you see the little people on the side as well? Maybe
Uh,
that's
We
just on my
also saw
screen.
ourselves too.
Okay, I'll scoot it over a bit. Is that better? A little better?
It looks
I don't know.
looks good to me. I think I can see the presentation if it's up to me.
Okay,
I'm on
yeah,
a very small screen, so
okay, very small screen, but we're happy to have you, Martine. Okay, so today's presentation is on creative real estate. What does that mean? I'm not covering all forms of creative real estate finance, but specifically seller financing, loan assumptions, and mortgage wraps, which are perfect for today's market. And we will talk about why that is. Now, my disclaimer for those of you that know me, I am a real estate broker. I'm not an attorney. I'm not a financial advisor. I'm not a CPA. I'm doing this presentation strictly for educational and entertainment purposes only. It's not legal or financial advice. So if you are doing a creative real estate deal, and I'll mention this again, be sure to consult your professional. So some of you know me, some of you don't. I have been in real estate now for 20 years. I have experience not only as a real estate broker, but I am an investor. I'm a landlord in Seattle, and I've been a property manager both for myself and for clients in the state of Washington. As an investor, I'm focused primarily on residential real estate, mostly on short-term furnished rentals, long-term holds. I've got an Airbnb. I recently built a detached accessory dwelling unit. But I've also done some small commercial development projects and land pre-development. And a lot of the certifications that you see at the bottom are related to working with investors. I've been very active with our local real estate investor association, which is REAPS, the Real Estate Association of Puget Sound. And that's where I've learned a lot of these techniques. The techniques I'm going to share with you today, most real estate agents have never heard of them. They don't know what they are. They don't know how they work. So investors know these techniques, and I'm going to share it with you. So why is this such a great market for creative real estate finance? And I think this situation is pretty much true all around the country. So Sharon Wu, who's jumping in from Southern California, this will probably sound very familiar to you. There are simply not enough houses for sale on the market right now. Home prices, surprisingly, still going up despite higher mortgage interest rates that we're not used to. And homeowners who do have mortgages have historically low mortgage interest rates on their underlying finance. It is a seller's market in most every major market in the country, including Seattle and the Seattle area. And yet, despite being a seller's market, 30% of all listed residential properties here in King County have been on the market 60 days or more. I keep checking that. It's right around 30 days. Well, if you're a seller and you've been in a hot seller's market and your home has been sitting for 60 days or more, you are much more likely to be willing to negotiate, either on price or on terms. So terms being, you might be willing to consider seller financing. Now, if you're a buyer or an investor, the benefits of seller financing are your monthly payments are lower, you have lower closing costs, and you may have flexible repayment terms. If you're a seller, the reason you might want to consider selling on seller financing in today's market is you're going to get a higher sales price. You'll get a higher rate of return on your money. You may have a quicker sale. You'll have a bigger potential pool of buyers. And I don't want to get too much into the weeds because I'm not an accountant, as I mentioned. But it is possible to use seller finance to defer capital gains tax. And for anyone, Martine, who's been a homeowner for a long time, there's been a significant amount of capital gains. And that would be subject to capital gains tax when you sell, unless you can defer it in some way. So that's one benefit of seller financing. Another benefit, and this would apply to elderly home sellers, is it's not an advantage for an elderly home seller, let's say, who's going in, has medical issues and is going into assisted living, to have a whole bunch of cash sitting around. Because Medicaid, which is the funder of last resort, will require an elderly person to run through all their cash before they start paying benefits. So seller financing can provide an income stream for an elderly seller while they still maintain eligibility for Medicaid. Pretty cool. So what is seller financing? So the typical seller finance transaction, the seller acts as the lender by providing full or partial financing to the buyer to purchase the seller's property. Now, that works really, really well when the seller, especially when the seller does not have a mortgage. And 30% of most homes for sale, the seller does not have a mortgage. But it also works if you can do seller financing if there's underlying financing. And that's where the seller provides financing for the buyer to purchase the seller's property, even though there's an underlying mortgage, in which the seller continues to make payments after closing. And I'll give you some examples. Okay, so Oscar and Daniel, right? This is a good example of offers that I actually am making now for clients or for myself. This comes from an actual email that I sent out to a seller. So I let them know that as an agent, I'm representing a client interested in this property if the seller is willing to consider financing. All of the terms you see below here in yellow are negotiable. In fact, all the terms in a seller financing deal are negotiable. So the first negotiable term is the purchase price. What are we going to offer on this property? Well, this was a listed property. It had been on the market more than 60 days. So I'm going after people who are motivated, sellers who are motivated to sell because they have not accepted an offer at 60 days. In this case, I offered full list price, which was $430,000. You don't have to offer full list price. It's all negotiable. But in this case, I want the seller to say yes. So I'm going to offer the full list price. Generally, in a listed situation, the broker on the other side expects to see about 1 to 3% put down as earnest money. It's good faith money to purchase the property. So in this case, I went pretty traditional and I said, we'll put down $10,000 in earnest money. Then the down payment, all of these terms are negotiable. I said I'd put 20% down here in this example. So if it's a listed property, I usually tell buyers 10% down. You want to put at least 10% down. Why? 10% will cover the seller's closing costs. If the seller has, let's say, 6% commissions, they're going to pay almost 2% in excise tax. There may be some recording fees, some of which are split with the buyer, so that they're at 9 or 10%. So 10% gives them a little bit of money to walk away with. in this case, I offered that the buyer would pay interest-only payments of $1,290 per month. So let me pause for a moment on interest only. Interest only means that the loan is not amortized. I'm not paying down any principal. We're only paying interest on the balance, but that the loan will be cashed out in 5 years. There will be a balloon payment in 5 years. So $1,290 per month is the equivalent of 4.5% simple interest only. So if they did the math on it, they'd say, oh, okay, she's paying 4.5% interest, which is more than what most sellers are getting in their bank accounts. So that might be a good deal for them. Another negotiable term, you can negotiate home inspections. You can negotiate other contingencies, sewer inspections, septic inspections, whatever, well inspections, whatever contingencies are relevant to the property. And that's all negotiable. Again, closing date, that's negotiable. If you're not getting a loan, you can close a lot more quickly, depending on what the seller wants. And then please let me know if your seller would consider this. We can go from there. Now, this is an email that goes out. It's not a great big written offer. It takes me a lot less time to structure this and get it out to the listing broker. I don't go to look at properties unless the seller says, yes, we would be willing to consider a financed offer. So any questions about a simple seller finance offer? This is where the seller can provide 100% of the financing.
So Wendy here, this is Martin.
Yeah.
I have a question real quick. So on the interest only payments, you consider those to be 4.5% from the balance after you pay the 20% down?
Yes.
Is that how the math works here?
That's what we offered. And
Okay.
depending on, the property and like, let's say I'm working with you to find a seller finance deal, maybe the numbers only work at 3%, or they work at 5%, or they work at 6% simple interest only. We could do amortized, we could offer, or the seller could counter at an amortized loan.
Right.
It's
So the question here is, how is that loan guaranteed? Because obviously, when you have a standard mortgage, the guarantee comes from the fact that you can use the collateral, obviously
Right.
the house,
Right.
as something you can get back in case the loan goes bad. So
Yep,
in this
that's a good
case,
question. That's a good question. Martine's a homeowner. So first of all, this seller is the bank. This seller is the
okay,
bank. This seller will have a lender's policy just like a bank does, and the buyer pays for that. Just like the
Okay.
buyer would pay for the lender's policy if it was a bank. This seller is secured by the collateral on the house. And we'll come back to that again. So if the buyer were to default, the seller can foreclose and get the property back, just like a bank would. So the seller is a
So
bank.
if I follow you correctly, and obviously this is a transaction where the title will be at the new owner. Obviously, he's going to be a lien holder on the property for the amount
Yes.
outstanding with this type
Yes.
of loan. Okay, gotcha.
Yes, very good question, very good understanding. And then what else do we do to protect the seller? Like you
Right.
decide, and these are good seller questions. These are questions that I get from sellers all the time when we run through a seller finance offer. So I want to give this example. I hope you guys can see this. So this is as an investor, every investor has one deal that made all the difference in the world, gave them the momentum to really kind of go over the top and move on with their investing at a much higher level. And this was the deal for me. This was a home that I purchased in Ballard, Washington. It's a neighborhood in Seattle. And I purchased it in 2011, 2012. Do any of you remember what the market was like in 2011, 2012?
Well, we're just after the crisis, so it was a little bit really low down there.
Yep. We were still in the Great Recession. Home prices hadn't really recovered. This house in Ballard had been sitting on the market, not 60 days, but I think it was 40, 45 days. And the seller was elderly. She owned it free and clear. She wanted it sold. I gave her her full purchase price, 409,000. I forgot that I even had gotten a private loan on it for 35,000. That was my down payment. So I basically bought this property with no money down, and I negotiated 5% interest only payments, not amortized, over 5 years, with a balloon payment obviously due in 5 years. And the seller even had to kick in $7,000 to fix the sewer line, the side sewer line. So I bought it for no money down, which was pretty amazing, on a seller finance note. And I can never figure out why that won't go forward. Okay, so this gives you some idea of what the property looked like when I bought it. I did put $12,000 in. I did some interior painting. I took out a wall. I renovated the bedroom in the downstairs ADU. There was a small 1-bedroom ADU. My monthly payments were just over $2,000. I did pay for utilities, and I was generating $3,700 a month in revenue. That's quite a spread. And you know, people say it's not possible for things to cash flow in Seattle. Yes, it is. You just have to structure the deal correctly. And so after all my expenses, and this was while I was getting the seller financing, it cash flowed over $1,000 a month.
Pretty good.
Pretty darn good. Now, the owner had rented out the whole house previously. She hadn't lived in it for a few years, and she was getting $2,300 in rent for the whole house. I was getting $3,700 because I was renting by the room. That's another whole training. But the house had 5 legal bedrooms. It also had a basement ADU. I had on-site, I never lived in this house. It was a rental for me, a rental investment property. I had on-site property managers that occupied the room in the basement ADU. They managed the property and they made repairs in exchange for rent credit. So let's look at the numbers on this deal. Seller finance deal, purchased for 409,000, 5% simple interest, 5-year cash out, a private loan that I repaid in like a year. I was making $3,700 a month in gross rents. My cash flow was $1,000 a month. 5 years later, when I refinanced into my portfolio loan, it was still, rents had gone up. I was still making $1,000 a month. So over 5 years, I made $60,000 just in cash flow. Just in cash flow. And at that same time, the seller made an extra $125,000 on the sale. So she got a full price, full purchase price for the house, plus an additional $125,000, which was, you know, interest income. She did have to pay taxes on that, of course, but not bad.
No,
And then-
that's pretty good.
It's pretty good. And then I sold it some years later with $400,000 in equity. I did a 1031 exchange into my West Seattle rental, which now conservatively is worth 1.4, 1.5 million. And I built a dadu that's now worth 700,000. That property today is cash flowing $5,000 a month. And that was possible only because I had this great seller finance deal in Seattle. So That's possible, but what if the seller has a mortgage? And let's say 70% of all homes on the market today have mortgages. Well, did you know that most government loans can be assumed?
Yep.
FHA is a government loan. FHA loans can be assumed. VA loans can be assumed, and some USDA loans are assumable. So here's a quick question. Do you have to be a veteran to assume a VA loan?
No.
Martine, you are scoring 100%. You do not need to be a veteran to assume a VA loan. So what a loan assumption means that you're buying the property, you're taking over the payments on the seller's existing loan rather than getting a new loan. You do have to qualify. You do have to qualify, which means you must be eligible to make those payments. And on many of these loans, you have to meet the terms of the loan. So many of them will require you to be an owner occupant. So you can't assume a loan if it doesn't allow you to be an investor. But let's
So
say
you're
you're
saying that we have to pretty much live in the property, be your primary residence to assume the loan? Is that what it means?
if the terms of the underlying loan require you to be an owner occupant, and I believe VA
Okay.
loans do,
Gotcha. Yeah.
I
Yeah,
believe,
that makes sense.
right? So Oscar and Daniel, I mean, we're talking about FHA loans out there, VA loans out there that are 2.5%, 3%. How would you like to assume a loan from a property you're buying that was 3% mortgage? Right? I mean, right now, people tell you, oh, you're never going to see a 3% loan again, but you could assume a 3% loan.
That makes sense.
So, yes, it does. So
It
buyers
depends.
are
It depends on the size of the loan, right? If
it-
how much
right.
years left on it.
Exactly. Good segue. That'll be the next slide. So certain loans are not assumable. So if it's a conventional mortgage, it's not assumable. Reverse mortgages are not assumable. What that means is closing agents won't close them. So we're not going to deal with most of the loans you see on the MLS probably are conventional. They're not assumable. But these others are. So again, let's run through the benefits and I'll get to Martine's comment there in a minute. Again, for a seller, you're going to sell your house. People are going to, if they know they can assume the loan, you'll probably get multiple offers. You'll get a higher price potentially, and you're no longer obligated on the loan. As soon as someone assumes it, you're off the loan. You can get a new loan for your new house. You're going to get a quicker sale. Buyers, this might be even better than getting straight seller financing 100%, because your loan term might actually be less than 30 years. There might be only 25 years left on this loan. You'll have obviously lower monthly payments and closing costs than what you would have if you got a loan today at a 6 or 7% interest rate. You don't need an appraisal. Lender's policy has already been paid for, and that means you could potentially afford higher priced properties. Pretty cool. All right, so here's Martine's question. The amount you'll need for a down payment when you assume a loan is the difference between the sales price you've offered the seller and the current loan balance. And that'll be the down payment amount. Oh my gosh, well, that could be $100,000. It depends how long they've owned the loan. If they've owned the loan a long time, they may have paid it down quite a bit. So you can either how do you make up the difference? Well, hopefully you have cash. You could ask the seller to do financing. The seller could do a second mortgage with a note and deed of trust, and you're probably going to pay slightly more interest on the second mortgage. If you had another property, you could take out a home equity line of credit. You could take a withdrawal from your 401k. And there is a company locally, I've never used them, I just got their name from our title company, called Assumption Solutions. So that if the buyer is really struggling to figure out how to do the loan assumption, they will help you through the process for a fee. I don't think you need to do them, but it's available. It's an option.
That sounds really interesting, Quentin. Quick question, we go back to the other slide. So you mentioned the fact that there will be a difference between whatever is the outstanding balance on the mortgage and the selling
Right.
price. Is that a
Right.
percentage that's considered be the difference? Because if we have like difference of more than 50% of between seller price and outstanding balance on the mortgage, that's quite a bit, finance you need to come up with as a potential buyer. So how would you structure that? Is that
You are so good at my segues here. I love it. I love it. That is exactly what we're going to.
oh okay.
So let's take a look at.
Can I
Oh.
ask one question?
Yes, go ahead, Sue.
So
Uh-huh.
the Assumption Solution, is that a company that help
Yes.
you? So do they?
Yes, I don't know if they're in Southern California though, Sharon.
Okay.
I
Right, that's
believe
my
they're
question.
local. But there might be other companies that can help you. Honestly, if you find an agent who works with investors and may be familiar with these techniques, they should be able to help you. It's not rocket science. I know it's overwhelming what I'm sharing with you now.
Mhm.
Um, but once you've heard it a time or two, it's who can really help you is your closing agent, your escrow agent. They understand this. They know how to do this, and they can work with your agent to help them. I don't know that you have to pay somebody to do other than your agent, right? If you've
Well,
got a good agent.
it sounds like what they're doing is they might be assuming the mortgage, and then lending you the money through them. So they might be working independent of state. I'm just
They
saying they're
they
in national.
they may do that, but you could ask the seller to finance it, and if the seller won't finance it, there are other sources perhaps to get a loan. It would be at a higher interest rate, but heck, you're taking on this really low interest mortgage. So we'll look at that example. Now, in this example, there's not that much equity difference. So let's say the purchase price is 1,275,000. Not an unusual price in our market, and probably not for you either, Sharon, down there in Southern California. Now, they have a loan balance of 1,162,455. So they've either refinanced or they had purchased it fairly recently. They've got a great interest rate on it, 2.75%. And there are lots of sellers out there now with these kinds of interest rates on their mortgages, right?
Right.
So yeah. Is
So
there a
my
question?
question here is, are you considering this will be an FHA loan or something that's assumable? This is not the
Yes,
standard mortgage, right? Okay,
this is an assumable loan.
gotcha.
Yes. So the buyer to take over this loan is paying 48.64 versus what they would pay today, which would be over 7,700 a month. So they're saving almost $2,900 a month by assuming this loan. That makes a big difference for a buyer.
Right on.
So this particular buyer put down 112,545. His total closing costs were less than 10%. So he put less than 10% down to take over this loan. And the seller, who hadn't owned the loan very long or had refinanced, still walked away with almost $27,000. So win-win for the buyer, win-win for the seller, right?
Absolutely.
So let's, whoops, oh, I thought I had another one. Oh yeah, I'm gonna do another one. All right. Thought I had another example. All right, I'll show you another example. Has anybody heard of subject to? Because I really won't talk about subject to unless you have specific questions about it.
Yes, I
Yeah.
think someone in the chat box posted.
Yeah, I've done quite a few by acquiring the property subject to and foreclosing from the second
Nice,
position,
okay,
foreclosing
all
from
right.
second position and taking over the property subject to.
Okay, all right. And I think we all, as investors, we go back a ways, we all did subject to. And a subject to is when the seller gets paid their equity at closing and the buyer takes over the seller's loan without qualifying to do so. So the issue is, this is a big issue for the seller. The seller remains liable for the loan. And they have no way to get the property back in the event of default. So good deal for buyers, but not so good for sellers. And many title companies will not close subject to transactions. So I'm going to show you a better way to do it. Same benefits, but better way to do it, where everybody wins. And that would be through a wraparound mortgage. So a wraparound mortgage is a home loan where the seller does keep their existing mortgage, but the buyer's mortgage wraps around the existing loan. So wraparound loans mean that the buyer is going to make monthly payments directly to the seller or to a loan collection agency, and it's usually at a higher interest rate than the original mortgage. Doesn't have to be, but it's typical. So let's say you found this great VA loan, Martine, but you're an investor. You're not going to occupy the property. So you can't assume it, but you could wrap it. You could wrap it. And it could be wrapped with something called a contract for deed. So VA loans and conventional loans. Remember, you can't assume a conventional loan,
Right.
but you can wrap a conventional loan. And both FHA and USDA loans may be assumed, but HUD doesn't allow them to be wrapped. So
Gotcha.
what does this mean? I don't expect you guys to remember which loans can be wrapped, which loans can't be wrapped, which loans can be assumed. When I say they can or can't, it has to do with whether or not a title company, an escrow company, a closer will close these loans. So they will close a wrap on VA loans, on conventional loans, but not on FHA, not on USDA. So this is where, if even if your agent knows what these are, but they're not that familiar, what loans you could do what with, it's good to talk to a closing agent because they can advise you the best way to structure this. But are you guys following what I'm saying? Is virtually every mortgage can either be assumed or wrapped.
Okay.
Right? All right. So let's talk about a wrap for a second. I mean, I think this is so exciting. You can close with a wrap using a note and deed of trust. And when you use a promissory note and a deed of trust, title transfers at closing. The other way to close it is on what is called a real estate contract. That is the legal term. It's also known as contract for deed. Real estate contract sounds like it's just paperwork, but it's actually installment payments where the seller keeps the title until the buyer pays off the loan. So in one instance, the title transfers. In the other instance, the title doesn't transfer until all the payments are made.
So in the first case, is that what note and deed of trust is referenced to?
they're different legal instruments that
Right.
transfer ownership.
I was just trying to follow you through on this one. So in this case, you know, I assign a note with another party, and the payments are coming to me for as long as the note, you know, specifies at which point, you know, the loan is repaid fully, and then this note I can turn back to the buyer in this case and release interest. Is that what you're telling me pretty much?
I'm not sure I'm following all of that, but
Okay.
in both cases, the buyer is actually a buyer,
Okay.
not a tenant. They are buying the property. And even though with a real estate contract, the title does not transfer, the buyer is entitled to possession. They have the right to acquire title. They get to deduct mortgage interest. They are treated just like a buyer. If they default on the payments to the seller, they are not evicted as a tenant, they are foreclosed on. Foreclosed, I forget the title, for contract failure, whatever.
I gotta
Um,
call the note. Pretty much that's what it sounds like.
It's called forfeiture.
Forfeiture, yes, thank you. All right. So here's an example of a low equity wrap, and this was a distressed owner. So if you know you meet sellers that are in distress and this guy might have seemed unrealistic. Most real estate agents would listen to this and say, there's no way, buddy, this is not going to work for you. So the seller said, I want to sell my home. I want to sell it for $340,000. I have an underlying loan, which will need to be wrapped. It can't be assumed. But that underlying loan is at 2.5% interest, as for $314,000. Well, this particular seller is also delinquent on his loan. He's delinquent by $19,000. And the seller says, yeah, I owe $19,000. You can have my loan, you know, we'll wrap it. But I want to walk away with $20,000. And this buyer, incredibly creative, said, all right, I'm going to put down $26,000 as my down payment. That's the difference between the sales price and the wrap. I'm going to pay that $20,000 that you want, Mr. Seller, so you can walk away. And I'm going to come up with whatever cash we need to close this deal. And I'm going to pay off the loan delinquency. So they came up with $88,000. $88,000 to close this $340,000 purchase. And they've got this great low interest payment with cash out in 5 years. They're going to take the seller off the note in 5 years. They'll say, we'll do the balloon payment. So win-win. I mean, the seller walked away with money. The buyer got this really great interest rate, and this was a seller in distress. So again, really, really great example. Now let's talk about something that's a little more typical. And this is where, Martine, I was thinking about, what if you've really paid down that loan
Yeah,
a lot,
That's right.
right?
Yeah.
So in this case, they didn't assume the loan, they wrapped it. So the
Okay.
sales price, $1,100,000. The seller's existing loan was $537,000. They'd already paid it down, you know, that less than 50%, right?
Mhm.
But it was at 3.5% interest. That's pretty nice, 3.5% interest. So this seller said, I'll tell you what, buyer, you put down a down payment of $165,000. That was all the buyer had, $165,000. I'll make you a loan for $935,000. And
The
it's going
difference.
to wrap my underlying mortgage. I am not paying off my mortgage. I'm going to continue to pay my mortgage, but I'm going to charge you 5.5%. Well, I mean, interest today, mortgage interest today is like 7%. So 5.5% is a good deal for a buyer.
That's true.
So they agreed to pay 5.5% on this loan that the seller's making to them with a balloon payment in 5 years. Doesn't have to be 5 years, just all my examples are that way. The seller paid their normal closing costs, commissions, excise tax, etc., $90,000. They got $76,000, 783 at closing. And then over 5 years, they made another $174,000. So they actually got $1,274,000 on the sale of this house. The buyer got a good deal. The seller got a good deal.
Now, the income from those to the seller as interest only, that's always something gotta be taxable, right?
The seller does pay taxes on interest. That's true.
So as a seller, you need to provide some paperwork, basically some accounting needs to be done for this loan, correct?
You are so good at my segues, Martine. I can't believe it. All right, I'm going to get there. So, and Martine's already raised several of the questions that you will get asked. Sellers will have questions, buyers will have questions. So if you're wrapping a mortgage, there's been a sale, and every mortgage today has a due on sale clause, which means the lender has the right to call the loan due if there's been a sale. So if the seller may call a loan due. Now, reality is the original lender is typically not even involved in these transactions. We don't need their approval as long as the closing agent is willing to close the loan. And so they're going to close the loan. The buyer is now making payments. The only way the lender would actually get notified is if someone misses a payment. So if you start missing payments, then the lender might be aware there's been a sale, they're unhappy, they're going to call the loan due. But as long as the payments are made, it's very, very unusual for a lender to call a loan due. They want their payments. They don't want the house. They want the payments. And I'll give you another way to make sure that, you don't have problems with the lender. So what happens if the buyer doesn't pay? And that was one of the questions Martine asked. If the buyer doesn't pay, then the seller's the bank now. The seller's loan is secured by that property. They can foreclose on the property. They can take the property back, keep all the money they've already been paid, and do it again. So you hire an attorney to, take care of that. What if the seller doesn't pay? What if the seller doesn't pay their mortgage? And I'm going to get to that in the next screen, because, if the seller is obligated on this loan and the seller's making those payments on behalf of the buyer, let's make sure that those payments are being made and there's not any additional encroachments. So these are real risks and these are real questions. And as I said before, I'm not an attorney, I'm not a CPA, I'm just sharing with you the advice and wisdom that's been shared with me. And I did run this by my title officer, the escrow officer, helped me put this presentation together. Always, always consult with a professional before entering into a seller financing transaction. I always tell my buyers, I tell my sellers, run this by your attorney, run this by your CPA. And I virtually always get a call back saying, she knows what she's doing. It's a good deal. This is a good deal for you. You should do it. Really. So we want to protect the seller. We want to protect the buyer. So in a seller finance deal, And particularly where there's a wraparound mortgage. I would highly recommend using a contract collection agency. They do exist. These are third-party neutral agencies. It's not your closing agent. It's a separate company. And we do have a couple of companies in this area. Can help you with Southern California. You'll have to research that. But Evergreen Note Servicing in Puyallup has a great reputation as a contract collection agency, and also Northwest Contract Collections in Shelton. So contact them if you're doing a seller finance deal. What they do is they collect the payment from the buyer. They take care of the payments to the seller's lender. So even though the seller's obligated, they no longer need to worry about this because the collection agency is going to make sure that their lender gets paid and gets paid on time. And then any extra money, like in the last example I shared with you, goes to the seller. And here's the great thing, Martine, you talked about paperwork. This company also does the year-end statements for taxes. So they
Nice.
both get, an accounting. And then they hold that original deed so that it can be reconveyed when the loan is paid in full. It's either
Exactly.
refinanced or paid in full. So it
Okay.
covers everything. It covers everything. And they don't charge very much. I couldn't tell you, but I mean, I know from what I remember, it was under $20 a month. And usually that's split by both the buyer and the seller because it benefits both of them and it's worth it, right?
Well, for $20 a month, that the $2,000-3,000 payment be serviced is pretty good.
Yeah.
Absolutely.
It's really good. So I ran through a lot of stuff. This is my information. If you don't have it, take a screenshot, copy it down. But this is your opportunity to ask any questions about anything that I covered or didn't cover.
I have a question. I don't know if I missed that part or. So you mentioned that if the buyer doesn't pay, seller can foreclose on the property. What if seller doesn't pay his mortgage? What can buyer do?
Right. Yeah, that's that would be pretty scary. You can always, if you're not using a collection agency, you can always ask for that the seller provides a monthly mortgage statement. But I think it's much easier just to use a collection agency because the collection agency will be making those payments. It doesn't even distribute the money to the seller until it's paid the lender.
It's pretty much like an escrow.
Yeah. Yeah. So your seller's going to be not only is going to pay, it may even help their credit because they're always going to pay on time.
So that
Payment's
goes
always
on
gonna be
everybody's
made.
credit score as well because it's a private loan. Okay.
Well,
Depends on the
loan-
service or not
Right.
all services report to the credit.
Yeah, okay. So Shri, do you have any other servicers that you use?
For the most part, we use FCI. They are licensed in all 50 states because we buy in 39 states. We buy non-performing notes and performing notes, both seller finance and bank originated. Madison Management does about 27 states. We use August REI for Texas seller finance notes. And name a state. Most of any states that don't have representation, most of the time FCI is for the rescue because they have a little bit more red tape in the sense it takes time to board the loan, but their online system is fantastic, and their charges are pretty reasonable compared to other servicers. So if you don't have any, FCI is the myfci.com is the website. That's all I would.
FCI. Okay,
My
well, thank you for that. Yes, if you're a note dealer, you're dealing in notes, then you'll be really familiar with these collection agencies. Yeah, that's great. Thank you for that.
Well, I have
It
a quick
takes a lot of the
question.
hassle out of it.
I have a quick question.
Yeah.
About when you compose a note, obviously has to be prepared by a lawyer, a real estate lawyer. and most of the information in the note will be pretty standard, I guess, but there'll be specific conditions, maybe about not only terms and amounts.
No, there's specific terms, but actually I close these deals using all MLS forms. There's a few forms, like I don't have statutory warranty deeds, but that
Mhm.
the escrow agent fills out. Honestly, I have the escrow agent fill out the promissory note, but it's based on the terms that are described in the seller financing addendum that is an MLS form. So I just use MLS forms. This is all, everything I've shared with you is on the up and up. I am not using investor forms. I'm using standard legal Northwest multiple list service forms. It's really
Okay.
pretty straightforward. Mhm.
That's good to know.
Yep. And I can do it. I can fill out all the forms. With the exception of, like I said, the promissory note, I have escrow, I'll include a blank copy so the buyer and seller know what promissory note's going to look like. And I may get a copy of the warranty deed from escrow and put in a blank copy, again, just so the buyer and seller know what it looks like. But it gets filled out at closing. Me, the real estate agent, I don't need to worry about it. You, the investor, you don't need to worry about it.
Then you mentioned something about taking insurance policy as a buyer, as a seller. Is that title insurance you're talking about, or you're talking about different type of
Well,
insurance?
the buyer, of course, is going to want homeowners insurance. The lender is going to want lender's insurance. And the buyer will pay for that.
Is that the
I-
property insurance you're talking about? Or you're talking about loan insurance?
Loan insurance.
Okay, gotcha.
Yep, like the banks get it when they're the lender. They get a lender's policy. Believe it or not, you probably never see that or know much about it.
Oh,
So
I should.
basically, the buyer's doing the same thing. Oh, yeah, you should, of course. Right, right. So we're just securing the loan like any good lender would.
Gotcha. That makes sense.
Yeah. Oscar, Daniel?
So when you wrap a loan, is that there's a third lender's policy for the seller to wrap the loan? Am I right?
It's not third. The buyer needs a homeowner's insurance policy, right? They would get that anyway.
Mhm.
And then the lender is insured as well. The buyer will usually pay for that because the lender is financing it for them. If it were a
And-
bank, there's no bank involved.
Right.
Okay, so you mean the seller is a lender and the insurance will cover the seller's lender policy and buyer is paying for that policy. Is that right?
The loan's already in place, so don't worry about the loan. Don't worry about that bank. Those payments have already been handled.
Right, so there is no bank.
There's no bank.
lender.
In every
Okay.
example I showed you, there's no bank involved except on an assumable loan. If you're assuming it, the
Mhm.
buyer is qualifying and they're qualifying with the lender. So the lender's well aware of it. And these loans are assumable. They'll work with you on
Okay.
assuming an assumable loan.
Okay, so I have another question regarding to the closing document for a RED. You say there are two kinds. One is a note and deed of trust, and the other one is the real estate contract, the
Right.
contract for deed.
Right.
Are they equally good, or would you prefer any one in any kind of situation?
you know, that might be up to the seller and the seller's comfort level, or where they talk with their financial advisor. And, you know, they may get a recommendation that let's do it this way rather than that way. You know, if the title transfers at closing and there's a note and deed of trust, that's pretty clean, it's pretty clear. However, a seller may say, you're wrapping my note, and I want to make sure that you're always going to, you know, make these payments, which, you know, you'd have with a servicer anyway. But I'm going to hang on to the title just in case, right? And you're going to make these payments. You're going to make payments instead. So several of you may be familiar with lease options,
Mhm.
right?
Yes.
And I've talked with investors who are like, you know, why do a real estate contract? I just do a lease option.
Lease to buy,
What's that?
lease to buy, right?
Yep. Rent to own, lease purchase, lease option. And basically, the title is not transferring. You have an option to purchase at a future price, at an agreed upon future price. But in the meantime, you're a tenant and you're making payments to the seller as a tenant, rent payments. So in Seattle, let's just do a Seattle example. In the city of Seattle, if you have to evict a tenant, it could take forever. Let's say a good 12 months to evict a tenant. If you're going to foreclose on a property, we can do it in Seattle in 4 months,
Wow.
right? So, you know, there's risk and reward. And I won't necessarily say one is better than the other, but this is where, if you've got your principals, the buyer and the seller, and they're consulting with their professionals, they may have a preference of doing it one way rather than another. And at least you understand that there are several different ways that these seller transactions can be handled. But the benefits are, seller, you get more money, you get a higher price, you have a bigger pool of buyers, you can sell more quickly. Buyers, you're getting an affordable rate that you cannot get with a conventional mortgage,
Not right now.
right? So it's an option.
For contract for deed, buyer is actually the tenant. So if they are
No.
not,
No, the buyer
Okay.
is a buyer. They are treated as a buyer, and the foreclosure, it's not foreclosure, it's for forfeiture of contract or whatever. There's a legal process that, you know, removes them as a buyer. Their contract is no longer good because
Wendy,
they're in default. They're in default of a contract as a buyer. It's a different process.
so
so
sounds like you know what you're saying is that for Seattle market at least, time wise, it's better just to have
That's
something
my
in
opinion.
place. Yeah.
It's my opinion, but there are certainly investors who love lease options, and I'm not prepared to, you know, go into the pros and cons, you know,
Gotcha.
other than that timeline at this point, how to structure lease options and using land trusts. And I mean, people get really creative. Like I said, I'm not covering every creative real estate technique today. This already took an hour just to go through seller finance, loan assumptions, mortgage wraparounds, but it gives you some ideas of what's possible.
Right on. Thank you, Wendy.
Yeah.
yes,
Oscar,
thank you, Wendy. So
yes.
one last question. I'm sorry. I know time is coming up. So in California, I understand that's a different procedure than Seattle. So if I want to ask my attorney, is that would way to find out if I ask them which one goes faster for feature of contract or eviction process. Is that right? Is that
Right. And if you've got Legal Shield or you've got, I know as a realtor, I also get free real estate advice. If you can ask through those channels, because an attorney's going to charge you whatever they charge you, but yes,
Sharon,
okay?
get some legal advice. Right.
Okay.
Yeah.
I stepped away
And
for a second. What was the question again, please?
Okay, my question is, do I ask my attorney whether eviction is faster in Southern California or forfeiture of contract is faster in Southern California, and whichever goes faster is the one I pick?
or whichever is least expensive, right?
Land contracts are definitely more time consuming
Okay.
in California, Georgia, Florida. I have personal experience in those states, so those are definitely more time consuming. Whenever it's more time consuming, and most of the time it's more costly too. Most of the time they're converting to judicial foreclosures because depending on how much down payment they can put, the borrowers or the future buyers can claim equitable interest in the property. That is the reason it becomes a longer term to complete the foreclosure or forfeiture. Yeah. So
Right.
what you want to look at is two aspects, right? What is the total cost to do the forfeiture?
Mhm.
And how much down payment are they putting down, the borrower? And how long is it going to take? And how long is it going to take? You're comparing foreclosure versus forfeiture in that particular state. So what I'm trying to say is in Georgia and Florida, land contract doesn't really do you any benefit. It actually
Right.
hurts you in
We won't
Georgia.
get
That's
into
correct.
land contracts. That's another huge topic, but obviously Shree's a great resource for that.
Is the
Before
land contract the same as contract for deed?
Yeah, same thing.
No,
It's called different
no,
in term. No.
no.
Bond for title, land contract, contract for deed, the intent is the same, but in
All
different
right,
states,
so
they're called by different names.
right, what I'm talking about is a real estate contract, which is not a land trust. It's not a land contract. And I don't want to get too far off topic here. So we'll just stay focused on real estate contract for the moment. But before we go, Oscar, Daniel, I wanted to check and see if you guys had any questions as prospective buyers that might be looking at this as a financing tool. Not hearing you guys. Oscar, Daniel, no questions?
No, it was very informative. Thank you so much.
Okay, all right, no questions there.
How do I
All
get
right,
a hold of how do I get a hold of the recording to watch it again?
I can send that to you, Oscar.
Thank you.
Happy to. All right, any other questions or comments before we adjourn? I'm so happy that you all jumped in. Shri, how do I pronounce your name? I want to make sure I'm pronouncing it correctly.
You got it right.
Oh, great. Well, thank you for being part of our discussion. You're clearly an experienced investor and doing a lot of creative finance. Did you find this helpful? You already have quite a bit of knowledge.
Yeah, I mean, it's always good to network and work with people in the industry. So you are based out of Seattle, right?
I am. And where are you based?
I'm based out of Northern Virginia, right outside Washington, DC.
Oh, my goodness. Well, it's late there now, isn't it?
It's 9 o'clock. Sharon
Not too
knows
bad.
me. Sharon knows me. I'm on meetings
Yeah,
until 1 in the night.
I wasn't
Oh.
sure if that's a 3, I know, but yeah, he goes very, very late.
Yes. All right. Well, it was a pleasure having both of you on the on this training because you asked a lot of good questions and provided a lot of good content. So I appreciate it. And if I could be helpful in any way, feel free to reach out.
Thank
Thank you,
you.
Wendy. It
Thank
was
you.
great.
Wendy, is
All
there
right.
your contact information in the email that you sent, or?
Yes, there should have been. Let's see if I can go back to my screen
I-
here.
Think I got your contact through Facebook. I didn't get your email.
Okay. All right. Yeah, I'm on Facebook too. So you can take a screenshot there, Shri.
Well, if I ever have to foreclose, I generally try to seller finance my foreclosed deals. So I might as well contact you if the property is in the Seattle area.
Awesome. Awesome. Appreciate that. All right, guys. Well, have a good evening.
Thank you.
Thank
Bye,
you,
Wendy.
you too.
Bye.
Bye, everyone.
Thank you. Bye-bye.